A very good evening to everyone, all our viewers, all our audience. Like I promised last week, we are back with yet another interesting episode of the Wealthcast. And this time, the topic is also something that each one of you have been looking forward to since a very long time. It is unearthing value. And when we're talking about value, I feel we have done a great job at getting perhaps the best that you can get out there in the industry. So today with us, we have S.Naren from ICICI Prudential AMC. Naren is the CIO and the Executive Director of ICICI Prudential AMC. So Naren, a very hearty welcome to you on the Fisdom Wealthcast. It's a pleasure having you on the show. So, Naren, we are very curious in life generally, and I like to believe that our audience also is. And just like you try and hunt for value, we value great ideas, we value great insights, and we value time the most. So, without further ado, I'm going to jump right into it and extract and absorb as much of your perspectives as possible in this short conversation that we're going to have. So, without any further ado, Naren. First things first, right? There's a lot happening in the economy. There's a lot happening, in the markets. People are having many different opinions of how the economy is shaping up. And why don't we hear it from you? How do you see the economy shaping up with so many nuts and bolts and flying around the place? So many pieces that are yet to fit together. How do you see the economy shaping up today? And what is your outlook on the economy for the near future?
So this year has been an unbelievable year, and if we had thought of in March what all happened in COVID between March and now, and how the economy recovered, I don't think any of us would have believed it. The reality is that when in 2008, when disaster struck, the central banks of the world did not know how to handle the disaster. So they took a lot of time to actually come to a conclusion how to handle the problem. So they had the 2008 toolkit in front of them. They knew what to do. So this year, what central banks took 9 months to do in 2008, they did it in 1 week in March. Because they did it in 1 week in March, they actually arrested the bear market in just 1 month. In the month of March. So what US did was they basically brought down interest rates to zero. They guaranteed a lot of debt papers in US and set the stage for a equity market rally in US. Immediately in India also we did a lot of things. And therefore what happened was interest rates in India came down by almost 2%. So if you look at it this year, you'll find that anyone who has taken a home loan this year will realize that they have taken it at the lowest ever interest rates that Indian home loans have ever been. If you are a corporate in India, you borrowed interest rates at the lowest interest rates ever. And for 3 months, most of the top corporates in India borrowed interest rates at 3.5%. And if you're a top corporate in India, you're borrowed for 3 years at 4.5 to 4.75%. And for 5 years, you're borrowed between 5 and 6%. These are interest rates which people have never seen. I don't think anyone has seen home loans of 7%. So that caused people to think, should I buy a house? Car loans have also become cheaper. And a number of trains are no longer running. So people said, should I buy a car? So a lot of people decided, let's buy a car. After all, car loans are much cheaper. Right. So all these things resulted in an economic revival after the lockdown. And that caused a revival in the economy. So if you look at the data of October, you'll see power demand has gone up year on year. If you look at two-wheeler demand, it has improved. Car demand has gone off through the roof. So if you look at even demand for credit cards, if you look at the Amazon, Flipkart kind of sales, they have been phenomenal. So overall, the economy is recovering where it can recover. Does it mean that a hotel or a restaurant has recovered? The answer is no. Has tourism recovered? The answer is no. Have there been economies, parts of the economy which hasn't recovered? The answer is no. Wherever recovery is possible, uh, the recovery has happened. And that is how the economy has been. And this is because of timely drop in interest rates across the world, a lot of stimulus given by a lot of governments across the world. And this has is what has helped the economy to recover. But I must accept there are parts of the economy which are not in good shape. So if you are an informal sector, and you're part of an informal sector, let's say connected to the tourism industry, connected to the multiplex industry, you have not recovered. So there are parts of the economy which are in bad shape, but there are parts of the economy which has used the current environment to recover. That is the kind of situation we are in.
Right, right. Very insightful take on how the economy is shaping up. This leads me to think about, so the very natural line of progression, right? Any market participant or anyone who has anything to do about capital markets, the only reason they speak about economy is to perhaps get an insight that will help them in the markets, right? So even I will follow the same suit and ask you a question pertaining to markets. So, given the way that the economy is shaping, like you said, right, the recovery is not going to be broad based. It is not actually broad based. Some will recover immediately, some will take some time, but it is not all going to happen together. Now, do you think that the market is also reflective of something very similar? Or, the thing I'm referring to is actually, quite the buzzword among media headlines. It is about the polarization in the stock markets, where the big are getting bigger and the smaller companies are not getting quite a chance to grow in the capital market itself. So do you actually see such a polarization evolving in the capital markets today? Do you see such a polarization among stocks? And the okay, I have a secondary question which I will state up front. Do you think there are more value traps being generated in the market more than value bets? If either yes or no, my primary and basic question is, how do you identify a value bet from a value trap? So the question is actually twofold. One, on the polarization situation, and two, your take on identifying value.
So these are two different questions,
Yes.
and I must talk first about polarization. See, luckily, I've had the privilege of seeing equity markets from 1989 when I started working. So that's a 31-year period. And I've gone through these periods of polarization. So if you go back to 1999, there used to be technology, media, and telecom industry. All the stocks belonging only to these three industries used to go up. So if people have heard of Infosys, Wipro, these are the great companies, but there were other companies like Himachal Futuristic, DSQ Software, Global Telesystem, Pentamedia. These were all belonging to TMT sector as they were called. So you had a polarization in the TMT sector. Then when I was a fund manager in 2007, there used to be polarization in the infrastructure sector. So we used to have road construction companies, power utilities, telecom companies. So we used to have a polarization in those sectors at that point of time. So now you have a polarization in mega caps. So what happens periodically, you will have polarization. And if you are going to get into those polarized sectors, when those polarized sectors are very expensive, you tend to lose a lot of money. So anyone who bought in 1999 technology, media, and telecom companies, they lost a lot of money. In 2007, anyone who bought infrastructure stocks in 2007 lost a lot of money. So frankly, polarization always happens. And at the time when the markets are getting polarized, those polarized sectors tend to become very costly. And at that point of time, the best way to measure a polarized sector is by looking at price to earnings ratios. And if you look at the trailing price to earnings ratios, and if they turn out to be very high, that is a sign of polarized markets. And in polarized markets, what will happen is that in Infosys was worth more than the entire metals and cement sector in 1999. In 2007, DLF was worth more than the entire pharmaceutical sector in 2007. And when you have these polarization, you'll find such strange things that one company is worth more than the entire sector. Just imagine you have a situation, one real estate company is worth more than all the healthcare, all the pharmaceutical companies in India. So that kind of polarization happens. What happens is, do you worry about the polarized sector, or do you worry about you see it as an investment opportunity in the non-polarized sector? So if you ask me, what we learned as investors is to find the investment opportunity in the non-polarized sector. And that is how actually we all ended up as fund managers, because we tried to avoid the polarized sector and look at the non-polarized sector. And that's how it happens. So this polarization is certainly there today. In 2017, people used to say we will invest only in small and mid caps. So there was a polarization in small and mid caps in 2017. We used to tell people, look at large caps, but people got polarized into small caps. But people who invested in 2017 in small caps, they've still not made profits. So what happens is, whenever there is polarization and you're clear there is polarization, actually you should sell out of that polarization and go into areas where there is no polarization. Frankly, you can have polarization even outside the industry, across. मैं दिल्ली जा रहा था 2012 में. Whenever I would go to Delhi, people बोलता था कि एक ही asset class है, real estate. Equity क्या है? छोड़ दो, real estate है. I used to tell them, ये क्या polarization है? एक ही asset class आप लोग देखते हैं, real estate. Equity भी है. 2012 to 20, वो entire Gurgaon, Noida में जो लोग invest किया, 8 years, no return. एंड जो बिल्डर को दिया, आधा लोग बिल्डिंग ही नहीं दिया. सो द फैक्ट इज, पोलराइजेशन करके इक्विटी पे नहीं होता है. समटाइम्स इट हैपेंस इन रियल एस्टेट एज ए सेक्टर. एंड जो लोग रियल एस्टेट में नॉर्थ इंडिया में इन्वेस्ट किया 2012 में पोलराइजेशन में, लोग रिटर्न नहीं आया. सो मेरा व्यू है कि इफ यू सी टू मच पोलराइजेशन, एक्चुअली यू शुड अवॉइड इट. क्यों अवॉइड नहीं करता है? In 2012, every neighbor was buying real estate. So you alone say, I will not buy real estate, I will sell real estate. So you look like some kind of a joker in your community. That is the only problem. But imagine in 2012, you sold your flat in Noida. You can now buy 5 flats in Noida. And now from reputed builders. Right. So that is the beauty of polarization, if you're asking. On your second question, if you look at value trap and value investing, I have a simple view. Whenever you buy any product, you ask yourself, are you using that product? So 2 years back, people used to come and tell me, telecom value trap hai. I used to ask them, do you use which telecom provider you use and how significantly do you use? So I used a particular telecom provider, and I used to, at one point of time, have one telecom, one phone only. Now I have one phone, I have one iPad, and now I'm doing this event on a laptop with a dongle. So I said, abhi ek time, एक टेलीकॉम इंस्ट्रूमेंट था, अभी 7 महीने से मैं घर में काम कर रहा हूं with 3 instruments, and people say my telecom provider is a value trap. And the company is the second largest telecom company in India, and every quarter they are becoming stronger and stronger and stronger. So I said, how can you lose money? So people say, no, power is a value trap. So 10 दिन पहले एक दिन क्या हुआ, 15 days back, one day, 3 hours power went in Bombay.
Right.
That 3 hours, Bombay virtually closed down. लोग बोलता है पावर वैल्यू ट्रैप है. पावर वैल्यू ट्रैप है तो 3 घंटा वी कुड नॉट लिव विदाउट पावर. Sorry, power is a value trap. 3 घंटा you cannot live with it. How is it a value trap? On the other hand, आज देखो, can we live without ambassador car? Yes.
Yes.
Can we live without Fiat car? Yes. Can we live without landline phone? Yes. So if we can live without landline phone, if we can live without ambassador car, if we can live without Fiat car, those are value traps. So I ask myself one question: do I use that product? If I use that product and if I am totally dependent on that product for 1 hour in the middle of the night, in May, I will ask you to switch off your current.
Oh, impossible.
And then you tell me power is a value trap. I will not invest in power. Or at 8 p.m. on any day, I'll say for 1 hour, I will not use power. 8 p.m. Then say power is a value trap. That is how I look at value trap. So value trap, I always look from this viewpoint. So if I'm dependent on telecom, I think it is not a value trap. If I'm not dependent on landline phone, I think it is a value trap. If I'm no longer using Fiat car or ambassador car, then that is a value trap. This is how I look at it.
What a wonderful way to put it, Naren. In fact, reminded me of Occam's razor theory, right? Wherein it says that quite often than not, the answer to the most complex questions is often simple and right in front of you. It's just that people just can't look at it, and you just portrayed the same thing, right? You made it sound so simple, but trust me, it is equally difficult. You have simplified it so much, but yet most of us are just not able to think about. We start getting too deeply analytical about things. We get stuck into a paralysis of analysis, and we'll end up doing nothing practically. Okay, it's not like we take any bet after thinking so long. We'll end up doing nothing. And as far as we're talking about investors and investor behavior, you also spoke about the fact about you spoke about polarization, and you said that people who buy into polarized sectors are actually missing out on the largest part of gains. If not, there's quite a probability that they won't make any money if they're buying into the sectors which is already polarized. So reminds me of also Carl Richards, right? He has this famous graph of how do investors behave versus how should they behave. So counterintuitively, the number one rule to profits is buy low and sell high, but investors, retail investors, we tend to do exactly the opposite, and that becomes the solid recipe for the exact opposite. That is the number one rule to make losses. In fact, as long as we're talking about investor behavior, Naren, this is a question that I keep asking people very recently, because it's quite a revelation, or it's quite an observation that I have made and noted of investors. I see that, so I deal with a lot of customers and investors on a day-to-day basis, okay? And I have seen the set has a huge chunk of people who say mutual funds are risky. Mutual fund में पैसा बनता नहीं है, mutual fund में पैसा जाता है, okay? Mutual fund is very risky. And out of that, a very similar set of people go and open demat accounts saying I will invest directly in equities. Okay, I see people finding it difficult to believe in a product so clean, transparent, and sophisticated like a mutual fund. But every second guy that I know has a solid stock tip in his hand. Okay, and apparently everyone around him is making money, so he's also opening a demat account. What is your take on this sort of an investor psyche? Have you also observed this happening? See, demat accounts, shooting through the sky, and people thinking about mutual fund. What is your thought? Have you also noticed such instances, and how do you view it?
No. People view as though mutual fund is one entity which always takes risk. Actually, mutual fund has liquid fund. Liquid fund is the safest product in the market. On the other hand, you can have small cap equity, which does take risk. You have products like balanced advantage fund, which are much safer than a typical equity product. On the other hand, you have products like large cap equity. You have safer debt products. So as you know, SEBI is also creating riskometers and various products. So mutual fund is a very generic product. So we have debt mutual funds. I think the most interesting thing is that in April, May, suddenly one day, people decided we'll take out money from debt mutual funds. As though every debt mutual fund is same as every other debt mutual fund. We spent 2 weeks explaining to every investor that don't take out money from every debt mutual fund, because every debt scheme is not equal to every other debt scheme. Now people have taken out money in April, May. They will end up now paying short-term capital gains tax.
Yes.
They will end up paying, when they file the returns next year, they will end up having to pay a fair amount of tax also on that redemption, because they have assumed that every scheme is equal to another scheme. And they have moved money at a wrong time and put that money in some account, then that account gives low return, then they have moved the money when interest rates have fallen. So the entire return that they could have got by staying when interest rates came down is also gone. So that is the challenge at this point of time, and that's the beauty of investing. So which is the safest time to invest in equity? When markets are extremely down, like March 2020. But another very safe time was October 2008, after Lehman failed. Who invested after October 2008? Warren Buffett. Did others have the guts to invest in October 2008? The answer is no. They didn't have that time. They didn't have the guts to invest at that point of time. So the reality is that, market is 2012 the safest time to invest in real estate? No, because real estate was very overvalued at that point of time. So this is the challenge for investors, that very often they don't understand what is risk. And the biggest challenge, if you ask me, is when something is very cheap, the risk is very low. So 2008 December, equity market had lower risk. 2020 March, when the market crashed 25% in equity, the risk was much lower in equity than it was in December 2019. And that is what happened. That is why what we did was we created a category called balanced advantage fund and tried to sell it to many people, which actually sold stocks as the way market went up and bought when it went down. So we were happily selling equities in January in that fund and buying in February and March in that fund, because we have come to a conclusion that for people to understand risk and buy when the markets are down and sell when the markets are up, people find it damn difficult. And that has to be done by us. And that is the only thing you need to do in investing. So 2020, is real estate a better asset class than 2012? Answer is yes. In 2018, was gold a better asset class in 2018 than 2020? Yes. We had a multi-asset fund where we bought 1,000 crores of gold in 2018, or 800 crores of gold. At that time, gold was much cheaper than what it is today. When we bought 800 crores of gold, people asked us, how come you are buying gold? Gold never goes up. But last 2 years, gold went up. So in any asset class, when it does very, very badly, to buy is lower risk. In any asset class, when it does very, very well, to buy is much higher risk. So if you look at US equities today, it is much higher risk today than it was in 2012. But today, everyone wants to invest in US equities, because US equities has done very, very well for the last 8 years. Right. So once an asset class, I feel, does well for 10 years, people think risk is low. But actually, when an asset class does very well for 10 years, the risk is high. So I used to ask people in real estate in 2012, why are you investing? They said, 10 years it has continuously gone up, so it will never go down. today in US equities in 2020, and people I ask them, why are you investing in US equity? They say, continuously it has gone up, so it will never go down. Just because an asset class continuously goes up doesn't mean it will never go down. Once something goes up for 10 years, you have to be more careful. Whereas something goes down for 10 years, you have to be much more comfortable. This is my learnings.
Right, right. Absolutely. In fact, reminds me of a very cliched statement that we keep making. That the problem with general investors is they have a strong hindsight bias, right? They look at how things have done in the past and they take their decisions basis that. It could be about how the markets have performed. It could be the trailing performance of funds. It could be almost anything. But like the cliched statement goes, it is always a bad idea to look in the rearview mirror and drive forward, right? You will obviously crash into something because you're looking at what you have left behind instead of focusing on the road ahead. And like you rightly said, this could be a great reason for why investors make the mistakes that they make, right? Talking about opportunities and talking about lows, okay, how opportunities created when things are at a low, it also reminds me, see, the most shocking media headlines, or rather the most sensationalized headlines a couple of weeks or a couple of months back was the GDP growth, okay, the quarter over quarter GDP growth hitting a negative trajectory. Now talking about GDP, if we were to break it down into its elements, okay, consumption, let's talk about consumption, right? Per capita consumption is not really taking off, at least the data is not looking great. Exports data is not looking great at this very moment. The government is trying to introduce a lot of import substitution strategies, but in my personal opinion, we are yet to see the results of such import substitution strategies materialize. Right? There's not a lot of private investment happening, no much credit offtake. So in such a environment where nothing is really shooting up from the ground, how do you view the GDP situation basis these elements? Like you may choose to club it or speak about consumption, exports, and private investment separately. But just some of your thoughts on these elements.
So we did one analysis and found that if you invested when GDP growth is very, very high, you lost money. And you invested when GDP growth is very, very low, you made money. So the only problem at this point of time is GDP growth is low, that is positive. The only problem is valuation is not very cheap. So if GDP growth is low is a positive. So along with that, if you can find cheap areas to invest in, and I'm refraining from talking sectors and things like that at this point of time. But I'm saying all you require is cheap areas along with low GDP growth. But this is one of the problems that people think. People think that you get high prices and bad news together. You get high prices and good news. You get bad prices, low prices and bad news. All this comes together. So somehow, no, people think you will get good news and bad prices together. You won't get it. So that is why 2002-3 GDP growth was very, very low. Share prices were very, very low. 2007 GDP growth was very, very high and share prices were very, very high. So today there is a problem not of GDP growth. The problem is GDP growth low is very good. Stock prices are not that low. That is a bigger problem. If GDP growth was very, very low and market was very, very low, I would just not worry. Because for me, in my framework, what I've seen is bad news, bad prices, you should buy. That is the framework that is where somewhere a lot of people think that if you have a lot of knowledge, you can make a lot of money. But in March 2020, think about it, market crashed. Did you need all the knowledge to buy in March 2020? Answer is no. You needed guts. You needed an emotional balance to say market is down 25%. India remains India. The human race is capable of defeating COVID. The human race is capable of managing COVID. So if 25% market is down, I have to buy. That's all. In 2008, when Lehman failed, you had to have the confidence. Market is down 50%. The world will manage somehow. The world will not allow the world to collapse. If the market is down 50%, we will find a way to manage. So we will trust the world and we will buy because the market is down 50%. So that is the challenge. So what happens? People think if you have knowledge, you will make money. But you didn't need knowledge to make money to invest in 2008 December. In fact, knowledge wouldn't have helped. Because if you had knowledge, you would have gone too deep into it and you would have got confused. In March end, if you were a doctor, you would have got totally confused by COVID. So my view is that actually it is not knowledge which matters. It is emotional balance and ability to think on your asset allocation and the ability to buy on sharp declines and sell on big rallies. That is what determines whether you can make money or not. This is my learning from my investing career, that to buy in 2002, you didn't know that a big bull market is coming. But you knew in 2002 that market shares were very, very cheap. Shares were very, very cheap is very easy to know. But you would not have known a big bull market is coming. No one knew. So I would say that instead of getting too much into this knowledge base, if you know how to handle your emotions and if you know how to handle your allocation to different asset classes, you can make money even if you're not as knowledgeable as so many people in this world.
Absolutely. Absolutely. I feel that is what differentiates true blue investors from the naive ones, right? Knowledge is available, right? You can take some efforts, you can garner. Obviously, it's difficult, it needs determination, but you can acquire knowledge. But emotional stability is not something that you can just acquire. It is something that you have to imbibe and bring it from within. You need to have the courage, the emotional balance, and just the ability to weather the storm, right? These such storms will keep coming in the markets. So Naren, today, as we are grappling with the COVID situation, the situation on ground still continues to remain hazy, okay, to a great extent. There are a lot of news pieces around vaccines coming up, but there is no real visibility on any of the vaccine yet. I mean, the visibility is as good as nothing because they keep saying that something or the other will come up. So, keeping the vaccine aside, what do you think can trigger the next leg of growth for India? It could be a particular story that you feel, or it could be a particular indicator that you feel. But what are the key indicators that one should look out for that will define India's next phase of recovery as an economy?
So I think what has happened is we have had one of the lowest interest rates ever. And that what happens is, there were two big problems after 2008 to 13 phase. One was the bank NPL problem. That bank NPL problem seems to have basically got resolved. There was a real estate problem that is also coming more under control because in the last few months, we are seeing real estate sales happening in many parts of the country. When these two problems get resolved, what happens is that the bulk of the capital allocation problems that exist at this point of time, they go down. Then you will see that the economy growth will recover a bit. Now, then if the world comes out of COVID, then the growth can pick up. But I don't think without a meaningful coming out of COVID, growth can recover to a significant extent. You need the world to come out of COVID. You need the world to say that everyone can travel to other countries. You need meaningful ability of Indians to travel from one city to another. All these things has to happen. And if that were not to happen, I don't think you're going to get back growth. I think the other parts of it are slowly getting handled. And if the real estate problem is genuinely handled across the country, and many of the unsold inventory of real estate builders get sold, I think that will be a healthy development. And that is what will pick up future construction activity. And future construction activity can create a meaningful impact on the economy. That's how I look at it.
Lovely, lovely. Makes a whole lot of sense, Naren. I feel these are the very indicators that one should have their eye on. Obviously, like whenever we used to have this conversation, also that recovery kab hoga. It is like you walk a few miles, you will hit a block where there is medical recovery. You turn around the corner, and then there is economic recovery just waiting for you, right? So I feel that is the situation in which we are. So obviously now I feel times like now are exactly the times that you spoke about. We have had as recent as March of 2020. In the past, we've had the 2008. I feel now is also an equivalent time, for some of the investment bets to actually offer a lot of value to investors. I feel investors should pay heed to the lesser known, less polarized. Pockets of the market to actually create wealth in the longer term going ahead. So while this was towards the back end of our conversation, we would just love to pick a couple of questions from our audience. I see the comment section continuously filling up with more and more and more questions. So like always, guys, in interest of time, I'll be picking a couple of them. But feel free to write to research@fisdom.com. We will try and help you. But I will pick a few on which Naren can lend his great insights and help you understand the situation. So the first question is, health of nations is not in sync with wealth of markets. What is your comment on the divergence between equity markets and the economy? So Naren, the first question, do you really think there is a divergence between the way the economy is going and the market is going? Is there a dichotomy between the two? And if yes,
I
what is
think
your...
I think one is you have to remember what are the interest rates.
Hmm.
Yeah, I think no people are ignoring what are the interest rates in the world.
Hmm.
So if you look at US for example, you have zero. So if you are at zero interest rates, what is the return you can get by investing in debt? Nothing.
Nothing.
If you are in Japan, you get negative
Yeah.
interest rates. If you are in Germany, you get negative interest rates. In India today, if you are a high tax paying person, you will get something like 3.5% post tax today. So, what is the return expectation that you get on an FD today? 3.5%.
Hmm.
So, that is what has resulted in equity valuations going to a different level, if you ask me. So I think people are not recognizing that the post-tax return on fixed income, on debt, is the main reason for equity valuations going to a higher level. So yes, there is a dichotomy. The dichotomy is people are comparing the valuations of today with the valuations, let's say, 7 years back, without recognizing that the interest rates today that you can get is very different from the interest rates you could get 7 years back or 2 years back.
Hmm.
2 years back, in many of the fixed deposits, you could get 8 to 9%. Try getting today, go to State Bank of India and trying to get 8 to 9% in a fixed deposit. Impossible.
Possible, not happening.
So that is where the dichotomy people are talking about is with reference. They do not recognize the drop in interest rates. That is how I look at it. If you recognize the drop in interest rates, the increase in valuation seem okay.
Hmm.
And if interest rates were to go back to where they were 2 years back, then I think yeah, markets would look overvalued.
Right. Very, very well put. And I feel most of us are guilty of looking at metrics in isolation. We have certain historical data and tear sheets on our screen, and we look at the data today, and then we decide if it is valued or overvalued without really understanding the other elements of the ecosystem and how is it. So you mentioned a very important point about interest rates. So for the audience viewers, whenever you're trying to judge a particular situation, a request would be not to look at metrics in isolation and not to just compare it with what it was, but to also look at but also do a holistic comparison of how was the situation back then when this metric scored this much, and how is the situation right now when the metric scored this way. So this should actually help you look at things in a brighter light. So Naren, we have our next question, a very interesting question, and in fact framed very interestingly. We are always asked to stay invested, but shouldn't we have an exit strategy? What factors should I consider when drawing up an exit plan? I feel this viewer is very much impressed by your thought about how not to buy into polarized pockets of the market. And so he's now asking of an exit strategy. How does one identify, or what could the lead indicators be of knowing that you are entering a polarized zone? When is the
So
right time
that's why
to
that's
build a
why
plan?
that's why as a company, we always have actually done maximum advertising of a product called ICICI Prudential Balanced Advantage Fund.
Yes.
What it automatically does is, if you look at this year, for example, in January it sold equity, in February, March it bought equity, February, March, April it bought equity, May, June, July it started slowly selling equity. Now as the markets go up, it will keep selling equity. So it automatically does the job of selling equity. So if you look at it, when the China problem happened in 2015, it bought. Then the markets went up, it sold. Then when ILFS problem happened, it bought. When Demon happened, it bought. Then when Divan problem it happened, it bought. Then there are different periods of time when the markets went up, it sold. So we think that in such a strategy, there is no need to actually do selling, if you ask me. Otherwise, I am a believer that even if you do an SIP, let's say in a small cap fund, I believe once in 10 years, there'll be a big bull market. And in that bull market, when you feel that you have made too much money, you should sell. And no one at that point of time tells you to sell. And the beauty about all the markets in the world is that people tell you how to buy. No one tells you how to sell. Show me a single person who told you have to sell real estate in 2012, sell small cap equity in 2017, sell infrastructure equity in 2007. Answer is no. We realize that the whole ecosystem which exists in this entire world in financial markets doesn't tell people how to sell. So that's why we said, let's create a product like ICICI Prudential Balanced Advantage Fund. But otherwise, if you're buying small cap equity, once in 10 years, there has to be a period when you made too much money. As such, the rule, if you ask me, is that when you're particularly in a mutual fund, is that when you made too much money, let's say you make in some year 100%, you should just take out the money. 2007 whereas a year where you made too much money, not a bad year to take out money. And does this apply to stocks? Answer is no. So I think that's where the challenge is. So in a stock, what happens if you start averaging stocks, you can go to zero. That stock can go to zero. Whereas in a mutual fund, when you do SIP, there is no problem. Let's say you buy a mutual fund, and the mutual fund, the NAVs fall. You can keep buying that mutual fund, because what happens is in an SIP there is no problem. But if you buy a stock, let's assume you buy a stock which are like Lehman Brothers or even the old Yes Bank. You had bought Yes Bank at 200, then it went to 75, it went to 50. You would have got into serious losses. So you can't do that in a stock. Whereas in a mutual fund, SIPs work very, very well. So I believe that averaging downward in a mutual fund is phenomenal. Similarly, when you make 100, 200% return too quickly, that is a time when you have to book profit. And again, I must tell you, no one will tell you. When you make 200% profit in a year, no one will tell you to book profit.
Right.
This is my learning.
Absolutely. Even I know, even when you make 200% profit, everyone's still gonna ask you to buy. I feel that's what happens in the market. I feel that is also the charm of the participants in the market, right? No one wants to let go of anyone. Everyone wants to hold everyone in the
At
game.
that time, greed comes in. At that time,
Absolutely.
greed comes in.
Right, right. So, like you have been, reinstating and, re-emphasizing on this entire behavioral aspect. At the end of it, we realize more than knowledge, it is about emotional stability. More than the money, it is about how you manage your greed and fear, right? So, very, very well put. I feel the question was also a very smart question. They asked on point that how do you sell? And I feel there couldn't be a better response other than what you just said. There is another very interesting question. So the question goes this way. My advisor says I have an asset allocation of 50-50. I want to do a long term SIP. Does it make sense to continue doing an SIP in debt funds if I want to stay invested for 10 years? So, this question is more about, I am presuming that for the long run, we all know equity is a brilliant asset class, right? So, the person is coming from a background that he's fearing that will I lose out if I do an SIP into debt funds? Does it make any sense to do an SIP into debt funds?
No, SIP in debt fund is fine. Absolutely fine. Somehow in India, we have created a situation. See, SIP in debt fund is like doing a recurring deposit. Is a
Hmm.
recurring deposit in a bank is acceptable. SIP in a debt fund is acceptable. The only difference is when you do SIP in an equity fund, what happens? Equity funds go through cycles.
Hmm.
So the markets go through cycles. So when the markets go down, you get the benefit of more number of units when the market goes down.
You're right.
So your SIP installments in February, March, April, May, they got you more number of units.
Right.
Whereas debt doesn't go through so many cycles. So the returns out of volatility is lower in debt. That's all. So
Hmm.
treat SIP in debt fund like a recurring deposit. There's
Hmm.
nothing wrong. Absolutely nothing wrong.
Fine, absolutely to the point. So this next question, I was wondering, should I pick it or not? Now I am, I'm going to take a chance at it. So the question goes this way. Sir, I have been an investor into iPro Value Discovery Fund since 3 years now. The fund is not showing any strong signs of growth yet. Should we hold on, or what is your view on the fund? What is happening?
Last 1 year it has done very well. First 2 years it didn't do well, but last 1 year it's done pretty well. Actually, it was the first 2 years when it didn't do well. So I believe very strongly in value as a category. And last 1 year, for example, if you look at it, both the technology and pharma stocks in the fund did extremely well actually. And I think on a 1 year basis, it has done fast. Or even on a 3 year basis, against most of the mid cap and small cap funds, it is done reasonably well.
Right, right. So I don't really know what was the expectation here, but I do agree that Value Discovery as a fund has done reasonably well, and for the 3 year period, it has done reasonably well. So obviously, I am presuming that given it was a value theme, and because
See,
obviously,
the challenge, what people don't realize, 3 years back, small and mid cap was a very expensive category. And
hmm,
this is something people don't realize at this point of time. And this is the challenge. And that is one of the reasons why we pounced on Balanced Advantage Fund, because we are not able to explain to people why did they invest when small and mid cap was so expensive 3 years back, and that has become a challenge for them. But this is the problem. That is why you need to adopt an asset allocation kind of framework and recognize asset allocation all the time. Today, for example, at 12,000, if you start investing suddenly, you're not investing cheap any longer
right, right.
in large cap.
Absolutely, absolutely. So one last question. I will take one last question. It is. Sir, do you think it is the right time to invest in small and mid cap stocks? It's a
Actually,
simple.
the way I look at it, no small in all the areas, growth stocks are costly today, and value-oriented stocks are cheap today.
Hmm.
That is true even in small and mid caps. I have seen some small cap pharma stocks, for example. They are quoting extremely costly, but there are other sectors where the small cap stocks are trading very, very cheap right now.
Hmm.
So it is no longer sector. It is no longer across the board that they are costly. Across the board, they are not cheap. It is sector wide. So, like if you look at our pharma fund, at one point of time, we used to aggressively recommend the fund. But now the fund has done so well that today I'm no longer able to recommend it because the fund has done exceptionally well. And small cap pharma stocks have got re-rated. Small cap pharma and chemical stocks have got re-rated to significant valuations at this point of time. So
Right.
I would say that I'm somewhere in the middle. So we've been recommending systematic investing because there are both cheap and costly stocks at this point of time.
Right. 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 Makes a whole lot of sense. So, guys, I know that there are a lot many more questions, and I am receiving several things. But like I said, in interest of time, I won't be able to pick it. Please feel free to write to research@fisdom.com, and we will respond to you. We will try and reach out to Naren's team, try and get their help. If not, we are here. We can work together and help you guys out. So meanwhile, getting back to the conversation, Naren, thanks a lot. I feel that was a lovely conversation. As we move towards the end of the conversation, I really need to hold myself back and refrain from extending this conversation in interest of time. I've been enjoying this conversation thoroughly. I wish I could go on and on, but again, we are on a clock, a timer, so I think we'll have to. Close it as we move towards the end. Once again, I would like to really thank you a lot for your time with us, with the audience. It was a pleasure hosting you on Fisdom's Wealthcast, and you have actually helped us unearth value, which was the theme of the talk today, unearthing value. I feel everyone who has watched the session now actually has an idea of how is value really unearthed. So thank you, Naren, for being on the show.
Thank you. It was my pleasure as well. Thank you.
Thank you, Naren. Good day.
Thank you.
So, guys, this was an interesting conversation. Okay, a lovely conversation with Naren. Naren has always been known for his value bets. He's always been ahead of the curve in picking and making investing decisions, which is not really visible to most of us. So he tries and digs beyond what is on the surface, and that is actually what has helped most of the investors make a lot of money with him and believing in his thoughts and words. So, guys, so a few key takeaways. I feel the most important takeaway was investing is more about emotions than it is about money. It is okay to make some money and lose some money, but all of it is going to be dictated by the way you hold your emotional balance. It is very critical to hold your emotional balance. The other point is not getting into a herd mentality. We had this question around polarization, and we spoke about how polarization actually happens in a particular pocket of the market, and if nothing, it reflects a very costly valuation in that particular pocket. So quite often than not, if you're buying what everyone else is buying or talking or raving about, there's a good chance you're not really making a smart investment bet. So be very conscious and know why are you buying a certain investment instrument, and if it actually makes sense from a valuation standpoint. So these are a few key takeaways. Another important takeaway for every investor out here is that the India growth story has just begun. Like Naren said, it is still very early days. We have a very long way to go from here, and the future looks much, much, much brighter than what it is today. Although today is bright enough, tomorrow is going to be much brighter. So, guys, like always, I am going to try and get yet another interesting guest on the Fisdom Wealthcast for our episode next week. Hopefully I'll get a confirmation soon. I hope the promise of this Wealthcast. I've been able to live up to the promise that I made to each one of you in the last Wealthcast, and this was at least an equivalent or much more interesting Wealthcast than what it was, what it has been so far. We strive to continue to get the benchmark higher. And guys, like I always say, you learn more when you share more. Do not forget to share this video with your loved ones. Trust me, the words of wisdom here could be perhaps the best pre-Diwali gift that you can give to your loved ones. I mean, it's not every day that Naren shares his words of wisdom and shares his secret sauce to making smart investment decisions in the market, right? So please share this with your loved ones. Meanwhile, do not forget to like and subscribe to the channel. Like this video, subscribe to the channel, share this video, and keep writing to us, guys. If you want a particular guest on the show, write to us, write to our team, research@fisdom.com. Share your suggestions, your feedbacks on the show. Share your suggestions on whom should we have next as our guest. We would make our best attempt at getting the guest for your benefit. And I really look forward to engaging with each one of you again. So happy investing. Have a great time, guys. Do well, stay invested.